Stop worrying about a Christmas Eve ATM glitch. The real financial deep dive is into the multi-trillion-dollar playbook designed to keep your bank running even if its parent company collapses without touching a single taxpayer dollar. Welcome back to the deep dive. This week, we really need to talk about something that just kind of exploded online. It filled up social media feeds with a whole lot of unnecessary anxiety.
You're talking about the Bank of America shutdown claim.
Yeah, exactly. The viral claim that Bank of America, or BAC, was getting ready to shut down every single branch nationwide for 24 hours.
Right. And we should probably be clear right off the bat.
These claims were, well, they were just unverified speculation. A lot of it was fueled by some general economic jitters and, frankly, a failure to just check a calendar.
The less dramatic reality is that Bank of America, basically every major bank and retailer closes for Christmas Day.
Yes.
Yeah.
A routine holiday closure. We're talking over 3,700 locations. It is not a systemic crisis. But this is where the conversation gets really critical, I think. The fact that a simple holiday closure can even start whispers of a national bank shutdown? Well, it forces us to look at what actually prevents a real crisis.
We're talking about massive institutions. Bank of America holds, something like $3.26 trillion in assets?
An enormous entity. So if a company that size truly did face an existential failure, what stands between an orderly resolution and, a catastrophic system-wide panic?
Followed by government intervention.
Of course. And the answer is a legally mandated, highly detailed plan, a living will, that's designed specifically to enforce market discipline.
And that's our mission for this deep dive. We're going to unpack the architecture of that plan. Specifically, we're focusing on the Bank of America Resolution Plan and its core strategy. The Single Point of Entry, or SPOE framework.
This is the playbook.
It is. It's the playbook built to make sure financial stability is achieved through private capital. It demands accountability from shareholders and creditors, not from the public. We're going to analyze how this huge financial institution prepares for its own potential failure using pre-positioned funds and internal crisis metrics to ensure that if the unthinkable happens, stability is achieved through private means.
Okay, let's unpack this central idea then. The single point of entry, SPOE. This is the mechanism that promises market stability while also achieving that ultimate goal of the post-2008 world, which is letting a major firm fail without public money.
That's right. The core philosophy here is fiscal discipline. This SPOE strategy protects the entire global financial system by enforcing a very strict separation.
A separation between what?
Only the parent holding company, that's Bank of America Corporation, or BAC, files for bankruptcy under Chapter 11. All of its material subsidiaries, and there are about 15 of them, the entities that actually serve depositors, like Bank of America, National Association, they must continue to operate seamlessly.
Okay, so that separation is the whole linchpin of the strategy.
It's everything.
Yeah.
It ensures that the losses, all the catastrophic losses, are imposed directly and entirely on the parent company shareholders and its unsecured creditors. They're the ones who absorb the loss. And that enforces genuine market discipline. It prevents the need for a government rescue.
It's a mechanism built on the idea that the private sector is responsible for the fallout of its own risk-taking.
Exactly.
It's best understood, I think, using the analogy from the source material itself. The SPOE acts like the crumple zone in a modern car.
Oh, that's a perfect analogy. Yeah.
The front section of the car, which is the parent company, BAC, it's designed to absorb the entire financial impact. It's effectively destroyed. But that sacrificial damage protects the reinforced passenger cabin.
Which is the network of subsidiaries holding all the deposits and maintaining all the core functions.
Exactly.
And that analogy works because the results are so clear. The strategy achieves multiple goals at once. First, you maintain critical operations. The subsidiaries, they just transition to a new structure, they call it NewCo, which ensures there's no disruption for depositors or clients.
Even if the holding company is gone.
Completely gone. Second, it avoids what they call competing insolvencies. BAC operates globally in over 35 countries, but by keeping the bankruptcy just to the U.S. holding company, they avoid total legal chaos across all those jurisdictions.
Which would be a nightmare.
A complete mess.
Mm-hmm.
And third, and this is the most important part of the regulatory mandate, the resolution is achieved through private means. No recourse to public support.
The principle makes sense. The holding company takes the financial hit, the operating banks stay open. But that separation sounds kind of fragile. I mean, if the parent company is collapsing, if its balance sheet is totally wiped out, how do the subsidiaries, the banks holding our deposits, actually keep operating? Where does the cash come from without a government rescue package?
And that is where the really complex mechanics of this self-rescue plan come into play. It all relies on rigorous pre-bankruptcy legal engineering to create certainty in what would otherwise be a moment of total panic.
So they have to set it all up beforehand.
They have to. The plan mandates a specific sequence of actions that must occur before BAC even files for Chapter 11. This is to make sure liquidity and capital are legally secured, walled off from the collapsing parent's reach.
So what does that structure look like?
The key is an entity called NB Holdings. It's an intermediate holding company that sits between the parent, BAC, and the operating subsidiaries. BAC established what's called a Secured Support Agreement. It's a legal document that obligates NB Holdings to provide ongoing capital and liquidity to the subsidiaries.
So it's not a handshake deal or some vague promise. It's a secured legal obligation.
Exactly. It's designed to survive any bankruptcy challenge. And the immediate trigger for this whole thing is something called the parent final contribution. Just before filing Chapter 11, BAC has to contribute the vast majority of its remaining financial assets. We're talking cash, high-quality assets, over to NB Holdings.
That's the final massive transfer of private resources.
Yes, to make sure the operating entities are fully funded before, the legal fireworks begin.
This pre-positioning sounds incredibly complicated, but I can see the purpose. It's to mitigate the huge risk of legal challenges, right? If they wait until after bankruptcy is filed, every creditor would immediately try to claw back that money.
Of course they would.
Yeah.
By doing it preemptively, they create the legal certainty that the subsidiaries have what they need to withstand the stress. It's a necessary complexity to satisfy that no bailout mandate.
And that funding stabilizes the new corporate structure.
Right. After the transfer and the bankruptcy filing, the material entities, the stable banks, are legally moved to a newly formed company called NewCo. NewCo is designed to be pretty much debt-free, managed by independent trustees. And the organization that eventually exits resolution will be, and I'm quoting, considerably smaller and simpler.
So it sheds the risky stuff.
Yep, it gets rid of complex, high-risk operations like the global markets business. The focus goes back to core consumer and commercial banking. That simplification is key.
Okay, but before they ever hit that crumple zone and start the bankruptcy process, they must need some kind of warning system. This can't just be a panic button. It sounds more like a continuous monitoring framework.
That's a great way to put it. They call it the Crisis Continuum. And your analogy is spot on. It's like a hurricane warning system for the bank. It forces management to act based on data, not on fear.
A hurricane warning system. I like that.
It's a 5-phase escalating framework, and it's all backed by specific, annually calibrated financial triggers. It forces the company to move from business as usual to crisis response based on objective, quantifiable data.
So what are the phases?
Well, they escalate in severity. Phase 1 is the stable phase, blue skies, business is fine. Phase 2 is heightened monitoring. This is the tropical depression forming offshore, early warning indicators, economic, market, reputational stuff get flagged.
Okay, so things are looking a little shaky.
Right. Then you get to phase 3, the recovery phase. The hurricane watch is issued. Financial stress gets a lot worse. At this point, the bank starts executing contingency plans to try and weather the storm with its own capital.
Boarding up the windows.
Exactly. Phase 4 is the runway phase. The storm is inevitable. Preparation for the bankruptcy filing begins. And this phase is quantified by one critical metric: the parent survival horizon. This is the countdown clock.
And the final phase.
Phase 5, the resolution phase, landfall. BAC files Chapter 11, and the whole focus shifts to stabilizing those NewCo subsidiaries.
The parent survival horizon. That's fascinating. That's the metric that removes the emotional human element from the decision to file.
It has to. It measures the number of days until the parent company's liquidity can no longer support the subsidiary's needs post-failure. When that number hits a critical point, it signals the exact moment BAC must file for bankruptcy.
Forcing a calculated, timely response.
Which is crucial. And that decision is guided by two other metrics that are constantly being calculated to make sure the subsidiaries have enough reserves to survive.
What are those?
They're called RCEN and RLIN. RCEN is the Resolution Capital Execution Need. It's the minimum capital each subsidiary needs to make the whole strategy work. And RLEN is the resolution liquidity execution need. That's the liquidity they need on day one post-bankruptcy to keep the lights on.
And they have to prove, down to the dollar, that the subsidiaries are self-sufficient.
They do. And this entire process, it requires intense internal controls. They have these comprehensive board playbooks for each entity and an assurance framework that requires them to exercise every single capability, from transferring assets to calculating RLNN, at least once every 2 years.
This is about making preparedness a non-negotiable, tested part of their business model.
This rigorous, self-funded, self-correcting system. It really stands in stark contrast to historical banking crises. I mean, in the past, governments were forced to react haphazardly, usually with massive public intervention. When we look at the history of bank holidays, the ultimate sign of a system breakdown, what does the historical record tell us about the dangers of failing to plan like this?
Well, history shows that improvisation is fiscally costly, politically destructive, and often just ineffective. When regulators don't have a credible, pre-approved resolution strategy, the outcomes almost always involve public distrust and taxpayer money.
Can you give us an example?
Sure, look at the past. In multiple major cases, Argentina in 2001, Ecuador in 1999, Cyprus in 2013, even the Rhode Island crisis here in the U.S. in 1991, pre-existing deposit insurance failed. It failed because the public just didn't see it as credible. And when depositors lose faith in the government guarantee, they run.
And authorities are forced to declare a bank holiday.
Which is really just a pause button on panic. It doesn't solve anything.
And the chaos that follows that kind of government indecision can be devastating. I remember reading about the Ecuador case in 1999. It's a perfect lesson in the cost of delay.
It truly is. The government there chose a broad, system-wide bank holiday instead of decisively resolving a single large failing bank, as its own central bank had recommended. That indecision, that delay, led to a much longer and deeper economic crisis. We saw it in other places, too. Political conflict, legal challenges, court rulings, they all undermined policy in places like Argentina, which just fueled more runs on the banks even after the holiday was over.
So the lesson is clear. A bank holiday only buys you time.
A little bit of time, and you have to use that time to act decisively. You implement comprehensive corrective actions, and you reopen only viable banks backed by solid capital.
Which is precisely the logic underpinning this modern SPOE plan. It forces the financial institution itself to do the corrective actions, the massive capital and liquidity transfers, using private funds based on objective metrics long before the government even has to get involved.
Exactly. It mandates proactive self-resolution. It's designed to eliminate the possibility of a chaotic, reactive, taxpayer-funded national bank holiday.
So what does all this mean for you, the well-informed learner? Let's try to summarize the key takeaways from this deep dive.
Sounds good.
First, the viral panic over a routine holiday bank closure is, well, it's completely unfounded. The real story is this incredibly complex, detailed, self-sufficient plan that exists to stabilize massive firms without relying on public intervention.
Second, the SPOE strategy is an act of mandated private accountability. The collapsing parent company is the required crumple zone. It's designed to absorb the failure, protecting essential banking services, and forcing losses squarely onto private shareholders and creditors. It is market discipline in action.
And third, that internal corporate health is tracked minute by minute. It's done using precise, predefined systems like the Crisis Continuum and that ultimate trigger, the parent survival horizon. This ensures the decision to file for bankruptcy is timely and calculated, not reactive. It's designed to prevent chaos and political interference.
And that level of self-governance really is the new financial standard.
Okay, so we've established that the success of the SPOE strategy really hinges on that strict legal and financial separation of the failing parent from its operating subsidiaries. But it only mandates that the resulting entity, NewCo, has to be smaller and simpler after failure. So here's a final thought. Given the increasing focus on eliminating systemic risk, and knowing that these giant firms spend almost all their time in the stable or heightened monitoring phases, will future regulators face political pressure to proactively break up these material entities? I mean, forcing that simplification long before a firm ever gets to the critical runway phase.
That's a fascinating question. The government demands simplification upon failure, but maybe simplification should be demanded much earlier to prevent the systemic risk from even accumulating in the first place. It really raises the question of whether these self-resolution plans are sustainable or if the government must eventually demand simplification from the start.
Something for regulators and citizens focused on fiscal responsibility to chew on. Until next time, keep digging deeper.